Hello, peeps. World economic news for Thursday. Start with Martin Wolf in the Financial Times. And these four charts taken from the IMF Global Stability PDF that I've got to read at the weekend, haven't I? Yes. US output, the top left one. And this is after recessions. And as you can see, it's the necklace one. The blue linky one at the bottom, and it's just firing out lower than it should be, well, compared to past recessions. And the top right is Eurozone, linky one, again exactly the same. After all the stimulus and all the zero interest rate policy and all the quantitative easing, all of that, and still Eurozone and US output firing well below what would be considered normal. Real credit growth in emerging markets is bottom left, which is quite interesting. The China one went up early. They did huge stimulus and credit growth, and they've been trying to pull that down to curb inflation, where the others are now increasing their credit. Brazil, India, Indonesia and Turkey increasing credit, and commodity price indices, and we can basically see they're all getting up, stiff and erect, and are forecast to go a bit flaccid by the IMF after that, but we don't know why they're forecasting that, but that's what they are forecasting. Moving on. This is from the Fed's new blog site, and they're boring. Anyway, this is year ahead wage growth expectations. This is what the powers that be, Fed being a very important one, are always scared to death of inflation since the trouble in the 70s and 80s. And they think that inflation really kicks in when wages kick in. And they're pretty happy to see that median forecast for wage inflation or wage growth expectations is very low. Now, in this blog posting from the Fed, they've got housing costs going up at about 3%, food at about 5%, gasoline at about 10%, and medical costs at about 8%. But they're pretty happy with that because it's not cutting into wage expectations. They note at the bottom, and they complained about the way surveys were made using the wrong questions. But as noted earlier, one significant area in which inflation expectations may influence consumer behaviour is in the wage negotiation process. But thus far, neither of these two questions that they were trying to work out which would be the better questions, prices in general nor rate of inflation measure, appears to be feeding into increases in expected future wage growth, which they'll be pretty happy with over at the Fed. Which, when you think about it, is well odd, really. They don't mind prices going up as long as wages don't go up. But if wages do go up, they'll put in the interest rate up to get the wages to come down. Or something like that. Either way, we're screwed. Right. Financial Times, this is about quantitative easing. And it's interesting that these charts depict inflows into structured products. You buy bonds in this, that, and the other, whatever bonds there would be. Top quality bonds has not been that much affected by quantitative easing, and that's what I have kind of been putting across. I would expect. But what is happening is that those top quality bonds, the corporate debt, etc., agency debt, because the Fed's been buying the treasuries, there's less of that safe debt to buy out there. It's a supply and demand thing. So although there is not a greater supply of money, there are less of that type of bond to buy. Yeah, so that's where the effect comes in keeping the prices up and the interest rates on those low. This is a quite interesting one. The source is the IRS in the US, but even so, I find it quite shocking. How much, if any, do you think is an acceptable amount to cheat on your income tax? In other words, do you think it's a good idea to cheat on your income tax? No, not at all, comes back at the answer. 2002 all the way through to 2009, well over about 85% of people say it's not at all the thing to do to cheat on your income tax. It's weird, that, isn't it? Statistics Canada gives us consumer prices rose 3.3% in the 12 months to March, the largest year-over-year increase since September 2008. You know, those standard 2008 consumer increases. So it'd be interesting to keep an eye on Canada, because anyway, that's the fact of the matter, and you can got the whole PDF there to read all of the info if you want to. Follow the link, follow the link. International Business Times, China regions face power shortages even before the summer peak. Things are not perfect in China. Central China's Hubei province has joined a growing list of regions facing coal shortages, with a warning on Monday that it is very likely to start rationing power this month if coal supplies remain tight and low water stocks continue to curb hydropower generation. It's not easy running a country of that size. FT Alphaville gives us throwing in the towel, renminbi edition. Quite interesting. According to this further bit, Gallo is bang on, and the quote from Gallo is, "If we are correct and various bank lending tools are losing some of their appeal," the bank lending tools, I won't go into them all, but the People's Bank of China have been trying these to get inflation down, and they haven't been working quite well. The PBOC may start to put more emphasis on China's exchange rate as a method of managing inflation risks. If so, it may be worth considering whether or not the PBOC might opt for a larger, more substantial one-off move in the CNY, the exchange rate, with a resumption in the crawling pace of CNY appreciation afterwards. In other words, they're raising up slowly, but to take a big hike up and then start slowly keep going up again. Interestingly, at an average of roughly 0.4% per day over the last 5 trading days, the 10-day rolling sum of intraday CNY midpoint fixes is currently running at its fastest rate since January. And is exactly what's being trial ballooned on Tuesday. Other options Zhu vaguely talked about, that was in the news, which at the bottom, which you could argue is what Ben is fighting for in the first place. Ben saying it's not our QE that's causing inflation in China. Well, even if it is, they can just adjust the exchange rate and conquer it that way. But everyone knows that China doesn't want to do that because it is export-driven country and doesn't want, there's very small margins on their exports as well, and it could drive factories out of China to cheaper areas. And yes, there are cheaper areas. An interesting one, Egypt and Iran are in talks to re-establish diplomatic relations and start developing bilateral cooperation in all areas. I won't go into that. Cotizalia says l'amore del sistema finanziario sube e febbraio I think what it's saying is, in Spain, mortgage defaults are now higher than they've ever been at 6.19%, I think. Recourse loans in Spain, like quite a lot in Ireland, Ireland's property's gone crunch down, but Spain hasn't gone down that much at all, really. And Spain, as pickings for the market, will remain alive, and not the vultures won't go in until there is a larger crash in the housing, and that could be the start of it. Basically the Spanish have been trying all methods that they can to pay their mortgages because they're recourse mortgages, but they're just running out of money and running out of time, and now having to default. The 1, 2, 3 I'm going to give you here are demographic time bombs, and to give you an idea, I'll do it in what is reverse order. I'll put Japan out first because we all know about the demographic time bomb that is Japan. You follow the link to get to the top 16, but I'll give you the top 3. Obviously Japan at number 1, Italy at number 2, and Spain at number 3. I think you've got South Korea at 4 and Germany at 5, but there are a lot of European nations in that demographic time bomb area, which is not the place to be. It's another sort of thing that you really can't get yourself out of, and it has to be dealt with. Problems everywhere, and not many answers. See you tomorrow for Fridays. Bye.